Coming in. In fact, there's a briefing that is being held by the economic advisor. Let's take a listen.
Key narratives from the economic survey 23-24, followed by a question and answer session. Over to you, sir.
Good afternoon, everybody, and thank you for being here. Just personal declaration, we didn't organize the rain to make it difficult for you to come here, so, but we welcome it, like all of you would, given the temperature we have been facing for the last several weeks. And thank you for being here. This morning, Mint very helpfully reminded me of what I wrote in the interim economic review in January. I had spoken about global factors, the introduction of artificial intelligence, the need to balance energy security and energy transition, and of course the imperatives of employment and skilling. Now this economic survey actually picks up on those themes. And more importantly, it tries to identify the areas and actions that we need to take such that these four important challenges can be addressed as best as possible. In some sense, this survey picks up on the theme that all hands on the table must be there, and no economic approach will be exclusionary or will be excluded. We need manufacturing, we need services, we need agriculture. We need the public and private sectors to act together. We need union and state governments to act together. Because given the way the global conditions are evolving, we don't have the luxury of picking and choosing specific approaches in our path towards Viksit Bharat. And that is the overall theme of the survey itself. First, the global outlook. You can see on the charts here that both merchandise trade volume and industrial production growth have steadily come down in terms of the averages over the last 20 years or so. Somewhere between 5 and 10%, they have come down to between 0 and 5, and now they are struggling to even stay above the zero line. So in general, global growth and global trade volume growth will be difficult to come by. And therefore, the way we can grow our exports will not be because the trade pie is growing, but because we have to grab market share in terms of competitiveness and quality, etc. And second factor, there is global protectionism and a sense of nationalism just in time giving way to the idea of just in case. Security dominates efficiency. Supply security dominates supply efficiencies. And you can see that in the last 3-4 years, protective actions have actually moved up very, very sharply, trade protective actions. And the reasons cited are on the right side: competitiveness, climate change mitigation, national security, geopolitical compulsions, concerns, etc. But this is going to be with us for quite some time. So we need to be mindful of that. And then the climate challenge and geopolitical fragmentation. We will be speaking more about the climate challenge later on in the presentation. It is about balancing, as I have written also many times in the last 2 years, it's about balancing economic development and also energy transition. But let's remember, historically, energy transitions have not happened in a single generation. Václav Smil has written a lot about it. And especially with so many countries going at it together. I can have it here. Especially with several countries attempting net zero at the same time and trying to achieve energy transition, it is going to be a major issue in terms of resource availability, etc., etc. And then when it comes to geopolitical fragmentation, we are seeing it every other day as well. And this chart on the right shows you how much the mention of geopolitical fragmentation is happening in corporate earnings releases and announcements and so on and so forth. from a bipolar to unipolar to multipolar world and different blocks emerging, etc. It is something that will be with us for some time. So these are the 4 headwinds that did not, for example, affect East Asia. Japan, East Asia, or China, when they were making their transition from lower income to higher income countries, they didn't have to face these headwinds. From 1979 to 2015, China, for example, did not have to worry so much about geopolitical fragmentation, climate challenge, and global trade. Globalization was at its peak. So we have to now chart our path to Viksit Bharat amidst these headwinds. That is why domestic growth becomes very, very important. Now we first quickly go through the state of the economy, where we are, which is covered in Chapter 1 of the Economic Survey. There is momentum in the economy. In fact, we are now 1 quarter in the new financial year, and even high-frequency indicators are telling us that the economy is carrying on the momentum that we have seen until the end of March 2024, when we grew at 8.2%. So the average growth rate in the last 3 years up to March 24 has been around 8%. And as we write in the survey, real GDP is 20% above the pre-pandemic levels. And the growth has been contributed to by a steady maintenance of the share of private consumption. Capital formation is beginning to recover as we would expect post-COVID and post-balance sheet repair. And exports are doing quite well under the circumstances as well. Of course, some of you might say this adds up to more than 100, but that is to remind you of the fact that it is not subtracting imports here. So otherwise, this is not net, it is not net exports, it's only exports, so it's a gross number. And investment is being driven by not only by public sector capital formation. Both union and state governments have clearly been spearheading the capital formation. But let me also tell you that private capex has been growing. Private capex has recovered. After the stagnation or decline we saw in 1920 and 2021, they did pick up in 21-22 and 22-23. Of course, some of you might go into the granular details available and say that private capex formation picked up strongly in the dwellings aspect and not in the machinery and equipment and intellectual property products, but even that post-COVID. So because if you look at the national income data, you can see the breakdown of private capital formation into these 3 components: dwellings, machinery and equipment, IP products, etc., intellectual property products. The recovery is beginning to come through in the latter 2 areas also, which is what exactly will be driving higher quality jobs. And household savings in physical assets has improved, and we have written enough about it. Households are not in distress. Households actually are investing in financial assets, which have done very well. Especially in the last 4 years, the foray of retail investors into stock markets through systematic investment plans, through mutual fund investments, has been quite prolifically documented. And our national income data do not record these at market prices. And that is the reason why there is a feeling that financial liabilities have grown faster than financial assets of households. But financial assets of households are not marked to market. So households are doing quite well in the aggregate. And if you also see the default statistics of small ticket loans, etc., they do not flag any signs of distress, and I have also written about them in occasional columns, etc. When it comes to the agricultural sector, which is the topic of a usual special chapter, and also a box item in the economic survey in Chapter 5, of course, the food grain production in crores of tons, 329 million tons, slight decline compared to the previous year because of the erratic monsoon. And also, let me tell you that this year, we will see a chart later, the monsoon is not exactly proceeding as the IMD told us before the monsoon season began. And while MSPs have been ensuring remunerative prices, we also need to encourage crop diversification with our MSP policies going forward, and that is why I would like to draw your attention to the box item in Chapter 5 as well. Industrial production, you can see a broad-based acceleration in all possible areas for the FY24, 9.5%, recovering very smartly from the overall growth of 2.1 in FY23. And the PLI schemes so far have garnered 1.28 lakh crores of investment, exports boosted by 4 lakh crores, employment generation of over 8.5 lakhs. So in that sense, the PLI schemes is actually gathering momentum, and the results are evident in several product areas such as electronics, pharma, etc. The PLI scheme is beginning to deliver very handsomely on key areas. The logistics performance is also contributing to the export resilience. Some of us might be wondering, what is the export resilience when the merchandise trade value growth appear to have declined in FY24? But you take away the petroleum products and gems and jewelry exports, even merchandise exports actually went up by little under 2% in FY24, apart from services growth. Whether it is the highway construction or in terms of the introduction of new trains and the waiting times in toll plazas, and the number of airports doubling in the last 8-9 years compared to how much we had in the previous 67 years since independence. Container turnaround time at Indian ports, in fact, the seaport statistic, which is covered in the external sector chapter and the services sector chapter, we do talk about the fact that the seaport turnaround time in India is even doing better than some East Asian ports as well. And the pace of railway electrification has also been quite strong. So there is clearly a cumulative and the lagged effect of logistics infrastructure contributing to export resilience and also overall economic efficiency and the relief of supply side constraints. Services export growth, the story of the global capability centers is very well documented, but this captures all of them in one place. India in general is ranked 8th in the business services exports, and 2nd in world telecommunication, computer and information services exports. And overall, India has a 4.3% share. In terms of the share of global value chain related trade, India's GVC contribution has gone up by more than 12.5 percentage points in the last 20 odd years. And the remarkable growth of the global capability centers, starting from the number of centers rising threefold, and in terms of the installed GCC talent, in terms of number of employees, going from 400 to 3,400 in terms of the number of GCC centers operating in India. So clearly, this is one area which might be not only somewhat immune to the introduction of technology, but may actually benefit from it. Coming back to the macro parameters, external debt ratio is much lower than many other countries. In fact, we have a very interesting box item on whether a strong or a weaker rupee is in the overall interest of balance of payments of India, taking both the trade and the capital flows together. From a BOP perspective, what kind of currency stance will be of help to India? It's an empirical exercise. It doesn't have any ideological preference on our part. We simply have recorded what the data tell us. It's very interesting, given that India has a very low external debt ratio. A weak currency doesn't hurt. If India had a very large dollar exposure, a weak currency will be problematic, because what you gain on the trade side, you might lose on the external liability side. But that is not the case with India. You may want to check out that box item. And exchange rate volatility is one of the lowest in emerging market space. Exchange rate volatility is one of the lowest in emerging market space. And the current account, while it was a surplus in the fourth quarter, overall for the year, it's about 0.7% of GDP. Last time when I stood in front of you in January 2023, we had just completed 1 year of recovery post-COVID. Now we are into our 4th year. And the main theme of the last full economic survey was how the medium-term growth is going to be supported by a much improved corporate and financial sector balance sheet. And that is what we are seeing today in terms of the non-food, non-personal loan growth running at more than 15%. and NPA ratios declining to 2.8%, etc. As long as we can keep the financial cycle going for a longer period, we can be reasonably assured of a baseline growth of at least 6.5%. Inflationary pressures under control. In the previous 3 years, the deviation of inflation from the target of 4% is the lowest in India, and the headline inflation rate is coming well within the band and should come to below 5% in the current financial year. And of course, you all know that the core inflation is running well below 4%. Monetary policy transmission is evident, and monetary policy stance may not necessarily be considered restrictive given the fact that credit growth is running in double digits as well. And both a slew of administrative measures and monetary policy combined to make sure that inflation never got out of hand. And compared to many other nations, the fact that we had a very small deviation from our target was facilitated by the proactive both fiscal and non-fiscal administrative measures and monetary policy measures taken. The continued improvement in the quality of government expenditure at the union government side is continuing from 88 and 12% ratio between revenue and capital. We are now between 79 and 21. So in some sense, you can see here that the decomposition of the fiscal deficit shows that capital outlay has been consistently increasing. And this is the World Bank recently has a development update which is probably on its way, and they talk about the fact that India's public sector capital formation is actually crowding in the private sector capital formation. Now, ultimately, all these macroeconomic statistics have to result in the most important variable that the public is looking for, our Indian formal sector creating enough jobs. If you look at it, based on the returns filed by Indian factories, about 2 lakh of them, in the annual survey of industries, factories which are more than 100 workers, they constitute roughly about 21% of the total number of 2 lakh factories. But they constitute 80% of the workforce. Therefore, it is heartening to see that the workforce growth rate in these factories, which have more than 100 workers, is 13.2% in the last 4 years, compared to the growth rate of only 4.8% in relatively smaller factories. So on top of a larger base of workers in the aggregate, factories with more than 100 workers are actually seeing their workforce rise faster as well. And that is a very good sign of formalization of the Indian manufacturing sector. And this is from the ASI data, which is available until 21-22. This is as far as the current state of affairs goes. Coming back to what I said at the very beginning, we are facing a very challenging global environment combined with climate change narrative and the change, and therefore we need to make sure that we pursue all possible approaches without any doctrinaire orientation or ideological orientation. If anything, pragmatism has to be the policy mantra. And second, in terms of the kind of reforms that we need to do, it is no longer about the big-ticket reforms that dominate your front pages, but more about the grunt work. It's about the nuts and bolts of governance. It's about the plumbing of governance that we need to get right in order to be able to drive growth forward. And that is the theme of Chapter 5 of the Economic Survey. What are the ways, what are the sectors, and what are the ways in which we can ensure that growth continues at a pace by which we can have a fair shot at our aspiration of Viksit Bharat by 2047.
All right, you heard from the Chief Economic Advisor talking in great detail about the economic survey that has been tabled.